Emil, good to see you. So ARM coming to market is a bit like reviving a franchise. It was public before. Everybody knows ARM. Qualcomm makes chips based on it. Apple's chips are based on it. Heck, Amazon's cloud chips based on this, and yet it's been passed around quite a bit. What's the significance of this for the market? Is it just something that's supposed to do well?
I think it's going to do well, and it's supposed to do well, John, and I'll tell you why. I think they're going to benefit from the AI pixie dust, I guess, that we're seeing around there. They've got a lot of things in development that I think are relevant to the computing power that AI needs. And that's where you've seen the run-up in NVIDIA in the last 6 months has gone up 67%. And NVIDIA, since the time of the acquisition, when they were supposed to merge a couple of years ago, is up almost double. And I think a lot of that's due to AI, and I think ARM's going to benefit from that. And I think it'll be a good IPO for that reason, even though Masa Son from SoftBank spent $30 billion on this over 3-4 years ago. Yeah.
So what is the signal then, if any, for the rest of the IPO market? I mean, this Johnson & Johnson spin out that we're looking for, again, kind of like a sequel. It's Johnson & Johnson. This is ARM. We've seen it before. I mean, the SPAC market has pretty much imploded. Does this help to open up a window, perhaps, or do we have to, look through understanding what the Fed's going to do going forward, debt ceiling, all that kind of stuff into the second half before the window opens back up?
Yeah, I think, well, first, we don't know when ARM's going to go public because they filed privately, so it could be in Q3 or 4. I don't think the Johnson & Johnson thing is going to have that much of an impact on the tech private company backlog. Instacart, however, which you just showed on that chart, will. If and when Instacart goes public in Q3 or 4, I think you'll have a lot of eyes on these private tech companies, whether it's Stripe or some of these other venture-backed companies, really look to the signaling that provides and see if 24 becomes a big year again for the IPO market for tech companies.
All right, I want to shift gears with you a little bit here. Uber finished the day up 5.5%. We get those earnings after the bell. We know they've been taking market share, at least here in North America, from Lyft. What are you watching for?
I'm watching for increases in free cash flow. They've had free cash flow for the last 2 quarters. So can they continue on that path? Because they have a big target that they announced for 2024, which is, I believe, $4 billion in free cash flow, which is quite a distance from where they're at the last 2 quarters. I'm also looking for stock-based comp. Has stock-based comp, which has been a big criticism on them, has it come down percentage-wise or nominally? And finally, and most importantly, I think, is the growth in food delivery. Growth in food delivery started to slow down across the industry, not just with Uber Eats. And if that, depending on how slow that gets, you then have to balance it with growth in Uber rides to see what the blended growth rate in the company is. And the multiple that Uber is going to trade at is going to be have a big impact from the blended growth rate. So looking at those 2 growth rates is going to be important tomorrow.
Yeah, I should note, before the bell, we get those results. I'm so used to saying after the bell with our show that it just slip of the tongue here. Anyway, quick last question for you, and that is, and I realize maybe, you're a former Uber, so you might have an opinion here, but what happens to Lyft? Are we going to see some sort of consolidation or M&A activity across the industry?
I just don't think so. Sadly, for Lyft shareholders, I believe they're sort of at the end of their growth cycle. There are, in ride sharing and in a subtle way, network effects. The bigger you are in any one city, the cheaper the rides are, the lower the wait times, the more drivers can make because they have more trips per hour. And that dynamic is starting to play out. Now, Lyft is being smart. They're doing a 33% cost reduction. I just don't think it's going to be enough. And when you talk about the merger market, you think, okay, Tesla, DoorDash, General Motors, Cruise. DoorDash has said repeatedly they don't want or need this asset. I don't think General Motors will take the losses and sort of the greediness of what ride sharing is. And I think Tesla's going in a different direction with their own self-driving cars. So I just feel maybe one of these orphan companies.
All right, Emil Michael, thank you.